Greetings guys, I welcome you in this beautiful video. So we are going to be learning about the relative strength index, also known as the RSI. So before I can get started into this indicator, you need to know as a trader that we have two types of indicators. We have leading indicators and we have lagging indicators. So when it comes to leading indicators, as the name says, leading indicators are the indicators that go before the price, but when it comes to lagging indicators, it is the indicators that goes after the price. For an example, in lagging indicators we have indicators like the moving average, and in leading indicators we have indicators like the oscillators, which is the relative strength index, and the stochastic. Those are the most famous one, but we have a lot of oscillators. So then today we are going to be focusing on how we can apply this oscillator into our trading. So when it comes to leading indicators, you need to know that the primary purpose of them, it is to help us when it comes to trade confirmation, because we can anticipate or we can analyze and forecast the market direction, but then for us to confirm the direction we need a certain tool. So the oscillators, they are used when it comes to confirming our entries or confirming our trade. So that's the primary purpose of it, but there are a lot of other applications when it comes to the RSI. So looking at it here, we have it below here in the second window. So all the settings, they are default setting. There is nothing that I've changed. So I recommend that you also use the default settings when it comes to the indicators. So looking below here, the oscillator, with the region in between, this region which is dark, which is the region between the 70 point and the 30 point. So what you need to know, the reason these indicators are called oscillators, it is because they move between 100 and 0, so they can never go below 0 and they can never go above 100. So that's why they are called oscillators, because they oscillate between these two levels. So then we have these other two levels apart from the 0 and 100. We have 70 and 30. So the 30 level, it is said to be the level that marks, or the level that indicate when price is oversold. So price being oversold basically means that now in the market there have been a lot of sellers and they've been selling for a while. So then the indicator analyzes and shows you that, okay, now the market is oversold. So if the market is oversold, then it is likely that we're gonna be seeing buyers, né? And then coming to the 70, it is the exact opposite, that this level, it is here to show you that, okay, now price is overbought. For an example, if you see price bridging this 70, it means that price here was overbought. And if you see price bridging this 30, it means that price here was oversold. So above it is overbought and below it is oversold. So what you need to know is that oversold and overbought, they are the main thing that they that can show you the possible direction that the market might move in. So it is not actually certain, but it just gives you an awareness that beware, now the market is overbought, and beware, now the market is oversold. So if prices are below or they are touching the 30, it means that be careful. It is likely that price is gonna change the direction, just as you have seen here. Price was overbought, and luckily price did change direction from being an upward move into being a downward move. Same thing applied here. Price was moving down and the indicator told you that be careful, price is oversold, meaning it might turn. So indeed price turned into becoming an upward move. So same thing applies in all the other scenarios. So basically this tool is here to just help you and raise awareness into you that, okay, now if you were a seller, it is time to change and look at the market into a buyer's perspective, because price is oversold. And if you are a buyer, it is time for you to change and look at the market into the seller's perspective, because prices are now overbought. So that's just a simple tool that you can add, whether you are using price action or you are using some kind of indicators. It is a very, very significant tool that you can add into your analysis just to confirm those entries, because we need something to confirm with. So the oscillators, they are found to be working best in that case or in that scenario. So the second thing that this indicator can show you, remember the first one, they can show you either overbought or oversold, meaning they can warn you that, okay, if you were a seller, just change and be a buyer, and if you were a buyer, just change and be a seller. So the most important thing is that overbought does not mean sell, ne? Let me just cross the equal. Overbought does not mean sell, and oversold does not mean buy, ne? Overbought does not mean sell and oversold does not mean buy. So that's the common mistake that traders make when they are using this tool. They interpret this as a selling signal and this as a buying signal and this as a selling signal as well. It doesn't mean that, because prices can stay, or this tool can detect some kind of overbought, but prices can remain up there without going down. So make sure that you don't use this concept of losing traders, because that's the mistake that they make. So let's check out the next application of this tool. So apart from applying this tool in terms of overbought and oversold, we can apply this tool when it comes to divergence. We can apply this tool when it comes to divergence. That's a very, very powerful concept or scenario that usually takes place in the market. So what is divergence? Divergence, it is usually a disagreement between the price and your oscillator. So usually when your oscillator is pointing a certain direction and the price is pointing another direction, let's say price is moving up, but the oscillator, they are now telling you that, yeah, price is overbought, so we are moving down. So this disagreement between the price, when I'm talking about the price, I mean the candle. So this disagreement between the price and the oscillator, that's what we call divergence. So that's another very, very important principle to warn you. For an example here, we can see that, okay, price was making higher highs here, as we can see, and it was as well making some kind of higher lows, but looking down here into the indicator, we can see that it was making lower highs, meaning the indicator at this point in time, it was detecting, or it was showing us that we are moving down, yet the price was still moving up in this region here. In this region, price was still moving up, but the oscillator was now showing us that we are moving down, because look, that's where we got a signal of price being overbought. That's where we got a signal of price being overbought here. But however, price didn't reverse immediately. They pushed up, although the indicator was going down. So this, when you see something like this, the indicator going down and price still going up, that's what we call divergence, and it's simply a warning that, okay, sooner or later price is going to go down. Remember, this is a leading indicator, so it goes before the price. So at this point in time, or at the situation of divergence, the indicator is expressing its boldness that sooner or later price is going to follow me. So indeed, price did follow the oscillator at this point in time here. So that's what divergence is, just a disagreement between the oscillator and the price, but it tells you that sooner price is going to follow the oscillator. So be careful. Maybe if you are a buyer, so you see these, then you have to be changing into looking the price as a seller. And if you were looking for selling opportunity, this tells you that, okay, be ready, the price can be going down at any time from now. So those are the two basic applications of the relative strength index. So I hope this is going to be helpful, and for this to be profitable, just go and apply it, go and practice it, and it shall work for you. So thank you for watching this video.